Hello, this is Brian Rezny, President of Rezny Wealth Management. I'm bringing an important update about the economy and the investment markets so you can understand what we see in the global landscape. You know, we've had a little short-term, over the last week and a half or so, a sell-off in some of the U.S.-based equity markets. And I want to go back and I want to talk a little bit about market volatility, not only with the stock market, but any investment, whether it's the bond market, treasuries, gold, oil, housing. Really, all asset categories have short-term bouts of underperformance or short-term corrections. This is extremely healthy. First off, corrections are usually marked by 10% movements down in any asset category. That would be a typical correction. Statistically speaking, most asset categories, not just the stock market, but as an example, last year long-term treasuries corrected about 15%, 15% negative, and treasuries were perceived as one of the safest investments in the world until last year they dropped 15%. Again, all asset categories don't go straight up, and I've never seen any asset category just go straight down for years and years and years. Now, of course, that could happen, but generally speaking, 2 to 5% negative movements in any asset category happen often between a dozen or more times in any calendar year. What that basically means, and I'll put this in perspective, if you had $1 million portfolio, you could easily see 3 or 4, 5% downdrafts or reductions in principal value throughout a calendar 12 months. It doesn't mean you physically lost money. It means values have come down a little bit before they retrench and have a possibility of going higher. Typically 3 to 4 times a year. We see 2% movements to the downside at least a dozen times a year in most asset categories. If we look at 10% market corrections, typically happen statistically about once every year, although you may see them actually as often as twice a year in heightened volatility stages. Again, short-term market pullbacks are very healthy for any investment category, not only the U.S. stock market, but any category. Anything that goes straight up is really a fool's game. Things have to come back to some extent, so I go back to my stair-step pattern that I've talked about many times. You can't go up 8 flights of steps without taking a breather. Essentially, the equity markets are acting where they've gone up 6, 7 steps. They need a breather. They're going to come down 1 or 2 before, as long as the economy continues healthy and continues to grow, which is exactly what we're seeing. We have a potential to go even much higher. Corrections, again, short-term, often last 2 weeks to 2 months. This is very natural progress for most investment sectors, not only the U.S. stock market, but all investment sectors around the world. So while we really have not received any phone calls from our clients concerned about this short-term bout of volatility, we again see this as a short-term pullback and an ongoing expansion of the U.S. economy. Now, of course, we're watching our indicators exceptionally close, as we always do. We're not making any knee-jerk reactions. We're not emotional investors. We do run a strict strategy. So again, these 2 to 5% movements on the downside can happen as often as at least a dozen times in any calendar year in most asset categories. Again, the U.S. economy, we're seeing better expansion. We're seeing general growth in the U.S. economy, and we're seeing improvement around the world. In fact, if I looked at some of the unemployment claim numbers that came out, we've hit the lowest point in basically since 2008. This is very healthy for the economy. It's telling us the labor market, generally speaking, is getting a little bit better. There was a recent research report that came out by Delbar. Delbar's done a research report about investors and emotional investing and knee-jerk reactions, and investors tend to do exactly the wrong thing at the wrong time, meaning they sell at market bottoms and they buy at market tops, and that is regardless whether it's bonds, real estate, which we saw, of course, throughout the United States, gold, oil, all asset categories. Investors tend to want to buy what looks shiny and good, and they never want to buy something that's cheap. So again, following a strict investment strategy, which is what we do at Rezny Wealth Management, we firmly believe as the economy U.S. grows, we're going to continue to be in those stronger sectors. We're always going to expect short-term bouts of volatility, which again, investors, is a very healthy sign of an improving economic state. If you're a client of Rezny Wealth Management and you have a question about your portfolio, please give our office a call. If you're not a client of our firm and you're realizing you need positive change in your portfolio, call us for a consultation. We always like taking on new clients to do business with. Have yourself a safe and profitable week.